Equities stage a strong recovery after opening in the red. Nifty closes above the 10,700 mark. Sensex adds 200 points. The Midcap index closes almost unchanged after recovering 350 points from the day's low.
Private banks lead the market rally thanks to a fall in yields. Nifty Bank outperforms the benchmark indices led by HDFC Bank. On the other side of the spectrum, Nifty IT index loses 0.5%, dragged by TCS, Infosys and Tech Air.
Oil prices continue to remain subdued as investors anticipate a drop in demand on fears of an economic slowdown. This gives crude sensitives a boost. Jet Airways and SpiceJet rise more than 4 to 6%. HPCL, BPCL and Berger Paints also cheer on slipping raw material prices.
NBFCs and housing finance stocks perk up on the back of the meeting with the Prime Minister. India Bulls Housing Finance, HDFC, Bajaj Finserv top the charts.
Bajaj Auto plans to foray into electric two-wheelers by 2020 with 2- and 3-wheeler products. Managing Director Rajiv Bajaj says that despite a muted fourth quarter for auto industry, he expects double-digit growth to continue into FY20. Well, those were the top headlines from Dalal Street. Hello and welcome to Markets Today Talk Back. This is the show where we tell you everything that happened in those 6 hours of trading in just 5 headlines. And today is a challenge because the market's completely surprised by starting sulking with the global markets and then recovering very sharply by end of trade to close at the highs. I'm Lata Venkatesh, with me my colleague Ekta Batra. Hi.
Hi Lata. Well, yes, thanks for that. And over the next 30 minutes, we will be talking about those top 5 market stories, and our guests will be answering all of your stock queries. Joining us to answer all of your stock queries today is Prakash Diwan and Ashwini Gujral on the technicals. Thanks, gentlemen, for joining in. But before we come to you, let's in fact take a look at how exactly the markets did fare in trade today. Lata, you gave us a bit of a preview in terms of what took place, the intraday recovery, the exciting kind of day that we had for our markets. Tell us more.
Well, to be fair, the global backdrop was extremely negative when we started. Yesterday, Nikkei had fallen 5%, circuit down on that major stock market. And the day before, the US markets had ended with a 650-point cut in the Dow. That's almost 3% gone. Crude was down $7 in about 2 trading days. $50, when would we have expected Brent crude to touch that kind of a low? So in that kind of bearish backdrop, the Indian markets chose to latch on actually to the crude crash and to the mild recovery that we saw in Dow futures towards the second half of trade. They did not latch on to the weak global cues beyond the first 2 hours of trading. But, I mean, to be fair, we gain a lot because of crude falling to $50. There was also some help that we got from F&O traders because tomorrow's F&O expiry, and even if you manage to keep the HDFC twins and a couple of private sector banks like, Kotak and Axis in the green, you're kind of home on Nifty Bank and to some extent on the Nifty as well. So is this all F&O machinations which are possible because institutional trades by their very nature are very thin in the last week of the year? Is that the story, or is India a genuine outperformer because of the nascent capex cycle, because of crude falling? All those questions will be answered only in the new year. For the moment, the market saw a celebration from the crude sensitives and the inflation sensitives. That held ground. But you tell us, Ekta, in more detail, stock-wise, what failed, what fired?
Well, yes, in terms of the top gainers within the Nifty space, it had to be Adani Ports. That stock really fired ahead in today's trade, up around 4%. And we had a couple of others, which was Z Entertainment, for example, which showed a sustainable kind of rally, ended at the high point of the day today. But it was really the entire financial space which led the recovery that we saw for the market. So HDFC, HDFC Bank, Bajaj Finserv, all of these stocks rallying anywhere between 1.5% to 2%. On the losing side, it was Sun Pharma, which lost out. We had Yes Bank, which was weak, and a lot of the IT stocks which didn't manage to recover too much. So TCS, for example, was down 1.5%. From the broader markets, Jet fired away on lower crude prices. Can Fin Homes was higher. Brigade Industries, there was a brokerage report on that particular stock, so that stock was very active. On Mobile lost around 15% today, so that stock was in focus. And a couple of these PSU Bank, Lata, for example, Central Bank of India was lower in today's trade, and even something like a Saturn Credit Care lost out.
Okay. Well, let's find out how things pan out from here on and what our guests are making of the markets. First, the technical view. Ashwini, what does the market look like? Does it climb further from today's gains? Would you take a bullish trade tomorrow or not?
Well, it depends on the size of the rallies that we have globally. But assuming we have a 500-point Dow Jones rally, in that case, a lot of it is in. Maybe tomorrow a bit more. But broadly, the sense remains that it is more a range-bound kind of market, which is extremely volatile on either side. And if you tend to catch it properly, you make a lot of money. Otherwise, trying to mess around in between the range is not a good idea. So if you get a gap up because of that rally, I think taking profits off would be a good thing to do. Friday's high and today's low now become the levels between which a short-term range is developing, broadly 10,530 to about 11,000, and also on the Bank Nifty 26,400 to about 27,400. Obviously, markets are light and they are tending to move much more sharply than otherwise.
Okay, all right, Ashwini. Well, Prakash, what were your thoughts in terms of the recovery that we saw, especially led by the financials?
I think a couple of things that you need to put in context. One is that the fall was primarily triggered by the global fears that we saw of slowdown in growth. And the very factors that actually predicate a slowdown in global growth are very positive for us. So, for example, crude. If crude were to be at these levels, it's mouth-wateringly attractive. And the impact could be much longer and much more sustained.
But did you get the sense that this is an FNO kind of...
Yes, so I was just coming to that. The activity, institutional activity is so dried out that, since last Friday, there was no hope of, no expectation of anybody. In fact, if you see the rollovers, for the first time, you see the rollovers have been very active, T-6.
Okay.
So most of the positions would have got wound up before people decided to proceed on whatever breaks they had. And now, I wouldn't be surprised if the volumes on the institutional side, both domestic and foreign, will be lower, but the local players would have been much more, dominant today. And that's where the recovery was in counters which had not participated earlier in this, rally post the election outcome. So, I haven't seen Adani ports do so well in a long time. Okay. I haven't seen Z come back. And there's nothing very specific about the rally. It's just that things moved up. And then this was largely Nifty led. And that's what tells you that this is probably more linked with the option activity, levels that option writers find more favorable. So wherever there's less pain, that happens. So it was, the broader indices didn't participate so wholeheartedly. It was actually Nifty. And I still feel the Nifty has legs. Whether it's because the heavyweights that could still move, the HDFC Twins, the ICICI Banks of the world. I mean, there's so much that could still fly off. So I think the next couple of days will be interesting. Tomorrow being the expiry day, and then of course Friday as a new start.
Okay. Well, yeah, we could probably, because of absence of institutional activity, see some kite flying by traders. We'll have to wait and see. But what is really India's dependence on this global story, and how scary is the global growth scenario? Joining us to answer those questions is Jeff Chaudhary, the non-executive chairman at RLC Ventures. He's joining us on the phone line. Jeff, welcome. Thank you very much. You're one of those who's working, at least for our sake, in the last week of the year, in this holiday week. Thanks for that. How scary is this global growth? Are we going to see this falling knife syndrome continue for a bit more?
Well, let me just say a couple of things. First of all, this week, from a foreigner's perspective, is a non-event week in the sense that most institutional investors are actually having holiday because of Christmas and New Year.
Yeah.
So don't put any sort of emphasis on what foreigners may or may not be doing this week, because essentially the senior people are not there. That's the first thing. The second thing is, as far as the global outlook is concerned, yes, obviously the market is now firmly in bear market territory. We've had a 20% correction in the US, but it's not over. I mean, next year, I expect it to be extremely volatile on the downside. And one of your guests earlier said falling oil prices for India is good. Yes, that is good, but a worldwide bear market is not good. And that's what I expect to happen next year.
Okay. Jeff, in that context, you don't think that crude will probably provide a cushion for the Indian markets and hence we become probably just a better choice as compared to other emerging markets, despite the global growth concern?
The bigger picture is global liquidity. Since 2008 to 2018, we've had the biggest injection of liquidity that's ever happened in the history of the world. Okay, so if oil prices go to, say, $45 or $40, that's, you know, in one sense, that's quite nice for India because of input prices and inflation. But if you have a worldwide bear market led by the US bond yield going up or tightening liquidity, that is much greater phenomenon than a $10 to $15 reduction in the oil price.
Okay. Well, actually, I was going to extend the question to India, Jeff. How would you approach India? You've been a veteran India investor, a seasoned watcher of the Indian skies. Does it look like there's this nascent capex cycle which will tick up despite probable political, coalition governments? Or do you think India will just succumb to this growth story, global growth story?
Yeah, I think there's a couple of things. I think what we've had over the last 10 years, particularly, is a very positive external global environment in terms of liquidity and interest rates and the printing of money. That external environment now is no longer there. I mean, you can basically say at the end of 2018, that was the end of the easy money, the global. So the external environment is going to be very difficult. From an India perspective, obviously there are things going on in India. The recent sort of resignation of the Reserve Bank of India and the interference by the politicians in the independence of Reserve Bank of India is extremely negative. Plus, we've also got elections coming up, obviously, and it's no longer certain that we're going to have, as we thought maybe 6 to 9 months ago, that the BJP will basically romp home and we'll have stable government. So the external environment is definitely negative. The independence or the lack of independence of the RBI is a negative, and we've got uncertainty on the political side. So that is not a very good backdrop for stocks to go up in India.
Oh, okay.
But Jeff, in terms of any sort of sectors, do you like anything where valuations are probably cheap in the Indian markets? We've seen autos fall, we've seen select NBFCs correct, private banks have had some amount of negative news. So there is maybe some amount of mouth-watering valuations for stock-specific picks in India?
Well, what I would suggest is if you can afford not to own any stocks, don't own any stocks for the next couple of years. Just literally be in cash, or, I think bonds in India are still quite attractive, sort of around 7%, 7.5%. They're quite attractive. If you have to own any stocks at all, and I would suggest very selectively, you own one or two of the very big blue chips like HDFC Bank or Hindustan Lever, etc. But certainly don't go down the cyclical route, don't go down the medium cap route, and definitely stay away from small caps.
Okay, my God. Jeff, I take your advice, but that's a rather severe view. If you have the option, won't own any stocks for 2 years. I mean, no faith at all in this Larsen & Toubro and Cummins and ABB all reporting larger orders?
Lata, you probably know me for a long time. I've been investing in the Indian market for 20 years.
Yes.
I also have been probably one of the biggest bulls globally of India. I just think that the environment that we're in an external situation, plus one or two problems domestically, is a very bad backdrop scenario. So I expect the market to be down 20-25% in the next 12 months.
Okay. Well, that's very important advice. Jeff Chaudhary, thank you very much for taking our call in spite of it being a holiday week for you. And that rather severe advice, one should note that actually fixed income is giving a very good return. And incidentally, Ekta, today the papers also screamed that this year FD, good old FD, would have given you more money than equities. So that's certainly a message which we should remember. With that, we go to the second headline.
Yes, absolutely. Private banks had a good run in trade today, all thanks to the fall in yields that we saw. The Nifty bank outperformed benchmark indices to end 1% in the positive terrain. HDFC Bank led the pack, gaining 2%. On the other side of the spectrum, IT stocks saw red. Nifty IT index lost around 0.5%, dragged by TCS, Infosys, TechM. Let's get in a couple of queries then. Manan has tweeted to us with a question on Tech Mahindra. He has 240 shares of the IT major, 650 rupees. Wants to know if he should sell or hold. Prakash, what would you recommend?
So, not one of my favorites at this point. And I, IT is another play that a lot could change from now to first half of Jan, when a lot of new contracts will come into effect, and especially with the currency being so unfavorable at this point. Typically, we tend to see contracts getting skewed towards against the IT players, because and then once the dollar starts appreciating, things could be different. But right now, the rupee is in that sub 70 zone. And then most contracts would factor that in. But on a more fundamental basis, I think the way TCS has kind of built its or diversified its sectoral presence and segmental expertise, I would still play it very safe with a TCS. Or if I had to take a little bit of risk rather than Tech Mahindra, it could probably be an HCL Tech, which is actually corrected post the acquisition from the IBM stable, because people have started getting a bit worried about the kind of borrowing that could be done to support this acquisition. But I think HCL Tech has always delivered, especially when it has taken aggressive calls in terms of go-to-market, and also it will be a balance between the sedate, boring performance from TCS and probably a little bit of fireworks from HCL Tech at this point.
Okay. Well, that's the advice for you, Manan. And with that, let's go to the third headline today. NBFCs and housing finance stocks perked up in the second half of trading on the back of news that these companies will be meeting with the Prime Minister. Indiabulls Housing Finance, HDFC, Bajaj Finserv topped the charts. And then there are questions, of course, on NBFCs. Tirth Trivedi has written to us with a question on Aditya Birla Capital. He says he has 100 shares of that company, bought at 150 rupees a share, has been holding the stock for 9 months now, wants to know what he should do, hold or sell. Prakash?
I know this is a tough call. I mean, the kind of hype that surrounded the listing, such a blue chip pedigree, and heady times, now at sub 100. But I would believe if he has the gumption to hold on for slightly longer, he could do two things. One is average out at these levels, because luckily for Aditya Birla Capital, it's into a lot of things, not just housing finance or not just retail lending. In fact, that's a smaller piece for it as compared to some of the other fee generating businesses like asset management, insurance and all. And I don't see any let up in that growth area at this point in time. So I think it's available because of the kind of sectoral negativity that surrounds the entire pack. And this is not going to remain, unscathed out of that. But at sub 100 levels, if you were to buy average out at about, get an average of about 125, 130, you would at least start getting into the money in the next 3 to 6 months. That's the hope. But if he doesn't want to take more exposure, it's okay to wait. Someday he will get that 150. Maybe it will take about 18 months, if not 12 months. But there's nothing to be so disappointed with.
Yeah, I guess no point selling. And, it's finding support at 97. In the past 2-3 months, it's found support at that level. So hopefully not further losses. Yeah, but it is really painful. Yeah. We'll take a break on that note. But do stay on. We have lots more stories that came out of Dalal Street. We'll continue to answer your questions as well. Back in a jiffy.
Welcome back. Well, you're still with us on Markets Today Talk Back. Ashwini Gujral and Prakash Diwan are with us to decode the day's action, answer all of your questions. We're through with 3 headlines. Let's get to the 4th headline for today. Oil prices continue to remain subdued as investors anticipate a drop in demand on fears of an economic slowdown. This gave a boost to crude sensitives, so stocks such as Jet Airways gained more than 6% and SpiceJet rose around 4.5%. Other stocks included HPCL, BPCL, Berger Paints. All of these stocks cheered on slipping crude prices. Okay, well, let's get in a query then. Twitter user Sujan Das has written to us with a question on Jet. He has 40 shares of the airline, bought at 834 rupees. He wants to know for how long he should hold on to this stock. Well, Prakash, I think that is the big fear. A lot of people bought into that big rally that we saw in aviation and now they're stuck. What's your sense? Do you think that Jet could probably even recover to his buy price? And should he even average?
It's 3 times. It has to
more
recover
than 3 times.
300%.
No, I fully agree the sentiment that Ekta is echoing, because I'm also kind of partially guilty of being bullish on Jet at that point in time and being so positive that things could look up. But then, the kind of air pocket that it's hit has been significantly damaging. The only respite here, Ekta, could be if there's an acquisition by a very strong name. And then you wait for the turnaround, not just the news on the acquisition, because the new acquisition can't happen at a very expensive price. Let's be very fair. I don't think any acquirer would want to give more than 300, 310, 320 at best for this stock. But if the acquisition goes through quickly and the government also backs it up in terms of having some sort of a balancing play as compared to Indigo, which is becoming fairly large, I think then give it 1 year's time and it could probably be in that 500 plus zone, 550, 6, I don't know, it depends on how things pan out, but he'll have to wait. I mean, fortunately, he's got only 40 shares, so I would not recommend an averaging, because it's still not, the time correction could be deeper, but he could at least get out of 800 of his buying price, whatever 800 place, could at least get 550, 600, which would mean that he's minimizing his losses. And if he gets a better deal somewhere along the way, he just needs to, jump ship and move into something else.
Yeah, bite the bullet.
But not at this price.
Yeah, you will get a better price to exit, though you may not get your entry price. Okay, that's a tragic situation to be in. But with that, let's get to the 4th headline of the day. And it's a CNBC TV18 exclusive. Managing Director of Bajaj Auto, Rajiv Bajaj, believes that even though the 4th quarter will be muted for the two-wheeler industry, double-digit growth should continue into FY20. He also adds that the auto giant, that's Bajaj Auto, plans to foray into the electric vehicle space by 2020. Here out some excerpts of a very interesting conversation we had with Rajiv Bajaj.
Q4 growth will be very muted for the industry in terms of primary sales from companies to dealerships. Although retail will continue at, let's say, the 10% year-on-year growth that we've been witnessing. I have no specific reason to believe that FY20 should be significantly better or worse. So, it's hard to predict the future, but I would assume this level of double-digit growth to continue. I think the biggest challenge for the industry is going to be to make this transition over these 2 norms related to safety and emission over, let's say, the next 12 months. So that's a big challenge for all of us. We will come in with electric vehicles for personal use at the top of the pyramid, because all new technology does well when it comes in at the top, because those consumers appreciate it and can afford it, and you don't have to bleed to introduce it. Now, whether it will be a scooter or a motorcycle, as I've said before, time will tell, but definitely before 2020, both in the personal space in the form of a scooter or a motorcycle, and in the commercial space in our 3-wheeler and quadricycle, we intend to be there with electric vehicles.
Okay, so that was the promise that came from Rajiv Bajaj. He also said that there are going to be 2 difficult issues. As you noticed, there will be the safety norms that will kick in next year, as well BS6 that will kick in for the industry. But there's a Twitter query, so I'll let Prakash answer all this. When I put this question to him, Surinder Sharma has tweeted, he wants to invest around 1 lakh rupees, and he wants to invest in Bajaj Auto. He wants to know what levels would be appropriate for him to enter the stock, and he says he has a long-term view. Prakash, I could just add on, you're free to advise at what level he should enter and whether he should only stick with Bajaj.
Yeah, no, that's a key point. I mean, you know, in two-wheelers, what we fortunately have is very distinct business models that all three large OEMs are following, you know, in the listed space, that is. So if you buy, let's say, into Bajaj Auto, you're buying a very healthy mix of commuter bikes plus three-wheelers plus exports. Now that mix is very uniquely positioned as compared to, let's say, Hero MotoCorp, which is largely, you know, motorbikes and a little bit of scooters, but largely India-based. You know, their focus on exports is not. And whereas you look at TVS, it's a premium segment, but motorbikes and a little bit of three-wheelers. So, and Bajaj has some very good optionality attached to the stock. You know, two things. One is, of course, the EV push, which he's talking about. The other thing is if the RE, the Qute, as it's called, were to, you know, get allowed to be bought by people and gets the support that it needs for commuting objectives, I think it could be a game changer for them. And what Java has told us, you know, the Mahindra launch that Java did, you know, Java was relaunched by the Mahindras and it's sold off so well, tells you that the market is hungry for premium bikes, but different names, different models, different variants. It's not just the Royal Enfield that you keep on buying again and again. So I think you could buy Bajaj Auto at closer to 2600 levels, but add a little bit of Hero MotoCorp to your portfolio as well. So it could be a 70-30, 75-25 kind of a mix.
All right, that's most useful advice, Prakash, and I hope Surinder Sharma heard you and benefits from it. That's all we can manage in this edition of Markets Today. Ashwini and Prakash, thank you very much for joining us. We wrap up this edition.